recorded. We're recording now.
Okay, great. Thanks, Tom. Before we get started, this is Capital Discussions. We're going to be having a presentation on technical analysis. I'm going to specifically show you how you can end up doing this on Thinkorswim. Just a quick disclaimer, Capital Discussions is not a broker-dealer or investment advisor. We have no way of knowing what your risk is, and I don't have the disclaimer in front of me, Tom, so I'm doing this by memory. We have no way. This is for educational purposes. That's okay. It's for educational purposes only. Okay, we have no way of knowing what your level of risk is appropriate for you. Trading options can be risky. The potential of loss is substantial. We're going to go over some hypothetical and simulated trades. We believe these to be accurate, but your pricing will differ based on such things as liquidity, slippage, and commissions.
And we're not making any specific trade recommendations.
Thank you, sir. What I'm going to end up doing is that I'm going to take you through a few things that I end up looking at. No particular order, but these are things that over the years, when working in different RIAs or hedge funds or investment management companies or advisors that I've worked with, that I found to end up being particularly useful. And so these are just, they were saved in alphabetical order, so it's not the way we're going to end up reviewing them. What I'm going to end up doing is that I'm going to end up going through where we are. Tom, I actually have URLs on the bottom.
Yeah, those are the, I put images, so if people want to see a full, like a bigger version of the image,
Perfect.
they can click.
And what I'm going to end up doing is that you guys don't have to worry too much about that, because after we go through this, I'm going to actually show you on Thinkorswim, and you'll end up having the full images. But the first ones that I end up having here that I take a look at is I like to look a lot at the internals of the market. Okay, when you look at the internals, you see like how the inner workings are moving on different things. And so what I end up having here is that I look at the highs and the lows. What I have is three different groups. Okay, if you take a look at the three different rows, okay, that we end up having, I look at them for the New York Stock Exchange, for NASDAQ, and something kind of unique that I've seen in Thinkorswim, I can look at them for the aggregation of all ETFs. Okay, the gray line behind what we're looking at, okay, if you see that gray background mountain type chart, those are the highs minus the lows. Don't worry about this because I'm going to end up showing you this. We're going to go into a little bit more detail. I just want to give you an overview, and then we're going to end up jumping into everything. What I look at is I look at the highs minus the lows, and the gray chart in the bottom is the daily average is the daily specific of what we're looking at. I like to end up seeing the trends. So what you're looking at is that the blue line is going to end up being the 5-day moving average of the highs minus the lows, and the magenta or pinkish color line is the 20-day moving average. So what you can end up seeing here is that the number of highs minus the number of lows is definitely has been on a downslope, right? That's a bearish sign. Okay, one of the things that you look for is divergence in your indicators. Okay, this is a really important one. So what was happening is that when we ended up bouncing up and then we were going sideways, what made me a little bit more cautious than normal was that I had this declining line on the moving averages of the highs minus the lows. I also like to see how it's broken down. So column 2 is just the highs minus the lows. So again, the top one is the New York Stock Exchange. The second one is NASDAQ. The third one is the ETFs. Now, this is like the worst of both worlds, like from a internals point of view. My number of new highs has been decreasing. My number of new lows is increasing. Okay. Now, this wasn't just, this was a revelation to me yesterday. because of the drop. No, this has been happening, okay, over the last, couple months. What I like to end up doing is that I keep this on about a 3-month window, okay, and I'll flash it up, okay. I'll have to take a look at this at least, once a week, okay. Um, I do the same thing looking at the advancers and the decliners. What you're looking at on the left-hand side is the advancers and versus the decliners. Okay. Again, I'm using 5 and 20-day moving averages. Okay. These are a little bit more spiky, but you do like to end up seeing that there's a trend in one direction or another. And here in the upper left-hand corner, this is the S&P 500. In the lower left-hand corner is the Russell 2000. I keep those there because those are two of the indexes that we end up trading. Okay. The center one is for all of the New York Stock Exchange, and the bottom center one over here is for the NASDAQ. So I can see no matter what I trade here, okay, the advancers and the decliners have definitely been flat to somewhat of a down trend. Okay. Now, advancers versus decliners isn't totally relevant unless I also take a look at the volume. Okay. And so here I could end up seeing that this is, again, it's the up volume minus the down volume. Okay. One of the reasons why, okay, this was so important to me. Okay, you guys can end up blowing this off if you want, but there was a time in my life when I ended up saying, you know what, I will never ignore this again. And there was a Raymond James analyst in early 2000 who was pointing out how up volume versus down volume and the number of decliners versus advancers was both deteriorating. What ends up happening many, many times during the last legs of a bull market, market participation gets narrower and narrower. This is called breadth, right? The breadth of the market. If all stocks are rising, right? You've heard the comment that a rising tide lifts all boats. Well, when the market's moving up and the economy is healthy, that's true. But in 2000 or in other environments, and you end up seeing, there was an expression that I learned a long time ago that I'll end up carrying it to my grave. It's that important. Volume leads price. Now, it's a little bit more difficult these days because you get the high-frequency traders, okay, and they end up having, additional volume for every one real share. Okay, I've seen estimates of a minimum of 4, sometimes as many as 12 or more shares might be traded behind the scenes because of what ends up happening in dark pools and the high-frequency guys buying and selling things repeatedly to be able to end up, playing with pricing. So it may be a little bit more difficult, or a little bit more masked. But in general, volume will still end up leading price. When you have a market moving higher, but yet volume is decreasing, that's not a good sign. When you end up having a market moving up, but the number of decliners is increasing compared to the number of advancers, that's not a good thing. What's happening is that the market is narrowing, and we're getting leadership from fewer and fewer and fewer companies. Again, these are signs that I look for when a market ends up turning. Okay, I also look at internals. Okay, every single day. This is one of the charts that I'll end up keeping up on my screen all the time. And what you're looking at here is just 15-minute bars, advancers minus decliners. That's all this is. Advancers minus decliners. This should end up being 0, okay, in a neutral market. I end up putting on, if you end up taking a look at this, I like to end up putting on Bollinger Bands around it, so this way I can see if our range is getting wider. One of the things that ends up, concerning me sometimes is that if we get a compression, in the Bollinger Bands, when we break out, sometimes it'll end up being, substantial. Okay, and so again, I do the same exact thing. On the left-hand okay, column. If you take a look at it, it's advancers minus decliners. I always put the New York Stock Exchange on the top, and then I end up putting the Nasdaq below. Don't worry about these charts too much, because what I'm going to end up showing you guys, okay, at the end, is how I end up doing this, and you're going to be able to end up for all of the capital discussion goal members. You guys are going to be able to end up downloading the charts. You can end up getting my exact grids that I end up using, and then you can move them around the way you want. But you'll end up getting everything that I end up showing you. Okay, so I end up looking at advancers minus decliners. Again, that's column number 1. I'm sorry, I made the same mistake again. Column number 2 is the up volume minus the down volume. Again, New York Stock Exchange and the NASDAQ. Then what I end up taking a look at is that I look at what's the total volume. Now, I also end up having this on another chart, okay, where I end up at this is total volume for the day, okay, and you can end up seeing these. I'm sorry, I said 15 minutes. This is the one, okay, that are dailies. It's right up there. It says that they're dailies. So these are the daily averages that I can end up seeing. So why was volume so high on this particular day? It happened to be an expiration, so you can blow some of that off. But one of the things that I'll always take a look at seeing where my volume is trending. Again, this is a bigger picture. If we've been running up over the last few days, this will end up being put into the graph, and you'll be able to see this. Now, I've purposefully, did not send Tom an update for these things, so you don't see yesterday's volume, right? Everybody's looking. Yesterday was this huge sell-off. What did volume look like? You got to stay towards the end of the presentation when I show you how to end up opening these things on the live one, and we'll take a look there. The last one is what I find is that I know tick. Okay, if you guys know what tick is, it's just basically the instantaneous push up or down in the market. Here's what I'm looking for. I'm looking at a daily range, but I want to end up doing an average of what the final tick was. Because what I find many times is that in the final tick, there'll be a lot of stuff that you'll end up seeing. Like, for example, when the market makers or big institutions are trying to end up, keeping a market up, sometimes at the end of the day, you'll see that it was all of the short-term guys, the intraday guys that were pushing it up, and so they want to get out of their positions before the market closes, so you see this really big last down tick. Other times, you've seen a market that's down, and then you'll end up seeing, the big institutional guys don't want to cause panic because we've broken some things, and you'll see, and this is a favorite of a tired bull market, you'll see big pushes up at the end of a day. Why? Because they're saving their orders and they're trying to group them in at the very last minute so they can actually have an influence on the closing price. So all the guys that only look at closing price think, it didn't move that much, I'll end up holding. Meanwhile, the institutions have been dumping left and right, and they just ended up buying, at the very last minute. Again, I'll show you some of that. Okay, now we get to the internals on a daily basis. Same exact format, right? Top row, I end up using the New York Stock Exchange, bottom row, the NASDAQ. And here, what I end up doing, again, I use my Bollinger Bands, but this, again, is going to end up being a much shorter chart. This is a 5-minute chart. And what I'm looking at is advancers minus decliners. And in the first 20 periods, right, because I'm using a 20-period Bollinger Band, is always going to have this big bubble. So it's absolutely useless, but I didn't know how to end up getting rid of it, if I ever wanted to be able to also scan back, which I do sometimes, I like to scan back a day, and that wouldn't end up working. So I can end up seeing here, what's the trending? Is the advanced decliners, are we getting better or are we getting worse, right? Really important to be able to see what that ends up looking like, this morning. We'll take a look at it, right? Because we started to sell off, we started to bounce, and now we're only down 1 on the futures. So we're going to be able to end up taking a look and see what's going on internally. Up volume minus down volume. Obviously, this is a bullish day. You can see that we started with more stocks that were up than were down, and then the volume ended up picking up on the stocks that were higher. Kind of interesting that it gives us a conflicting picture that there were more decliners. Now, here's a good example where while we had a day that looks bullish on the volume side, okay, the participation was getting narrower. Okay. Um, well, does that mean much because the up volume seemed to be so much stronger than the down volume? Well, again, we don't have enough information. We have to take a look. Is that volume particularly high or low in any given point? So what I end up doing in the next one over here is that I look at by hour. Each one of these bars is an hour of what the volume was yesterday and what the volume is today. So I can see during the day if we're tracking higher or lower on a day-by-day basis. I also have this chart that I break it out sometimes if I want to see more, and I'll look at a 20-day, on this, and that's easy enough to build, and I'll end up showing you that too as I get into it. We use tick, and then we use trin. If you guys don't end up knowing, Investopedia has good explanations. Basically, what trin ends up doing is it tries to end up giving you the up volume minus the advances minus decliners by the up volume minus down volume. So it ends up giving you a reasonable feel. One of the things that you end up taking a look at, trend sometimes moves counter, to the overall market direction. So you read up on it. You get. I'm not going to go through every single indicator, but it is one that to me it was worth keeping up there, and I end up keeping on. I'm going to look at momentum, and I'm going to end up looking at oscillators. Okay, and we'll end up showing this. And this is just the way I've set up my charts. What I like to do is I like to have regression channels in place. So I'm looking at the 100% and the 50%. Okay, the solid line is the 100%. You can see the green and the red are the 100% channels, and I'll end up showing you the 50%. And then I'll end up keeping a Bollinger Band in the center along with ADX, which we'll end up getting into in a minute. ADX charts that will end up showing, what the ADX signals say to end up on. Now, remember, these are momentums, so they're saying, hey, this thing is starting to end up getting a momentum up or a momentum down. I don't find them particularly useful, but I do like to know when people who are trading off of them are starting to get into the market because of that. I do see these types of well-known indicators do what I call crack and snaps. Right, they will crack through the level where the indicator will end up saying to go and buy. It'll end up taking, a half a step up and then take 3 steps backwards because all of the high frequency and algorithmic guys know that the people came in to buy. They saw that this ends up happening. And so a lot of these indicators won't end up working, but it's important, I think, or at least I want to end up seeing them. The DMI, ends up having, basically it's a momentum. Again, Investopedia has a really good explanation about it. Basically, what I'm taking a look at is the momentum getting stronger or weaker? The green line, will end up being, the positive, the D plus, if you will. They'll call it a DI plus, and then the D minus will end up being the red line. So you can see, is there more up, pressure or down pressure? They'll minus the 2. And the white line is basically the level of momentum. How strong is the momentum going? Is it going up or is it going down? Looking at that, Weiler had done a bunch of work on this, and it had created something called an ADX, and this is the strength of the movement. Not the direction of the movement, but the strength of the movement. So if I get a movement that's moving higher and the strength is getting stronger and stronger and stronger, again, the short-term direction line here is white. And so what we'll end up seeing is the market moving higher with momentum getting stronger, or is it getting weaker? Important thing I end up thinking to be able to end up seeing, again, just where momentum is and what's pushing it in which direction. One of the last things I'll end up taking a look at least on the first momentum, is the TTM squeeze. A guy by the name Pearson ended up developing this. It was on Thinkorswim. If you guys are Thinkorswim, they ended up purchasing the indicator from him. Interesting indicator that I actually think does a pretty good job. And here's basically the way it ends up doing. And you can end up reading up on it. There's a whole description on it. But basically, when the market's moving up, you can end up seeing something's bullish. But when it kind of hits its peak and it starts to come down, it goes from, at least on my charts here, it goes from light blue to dark blue to say that yes, while we're still moving up, the momentum is getting weaker. Same thing ends up happening, okay, here on the downside. The red says, yes, we're definitely below and the momentum's getting stronger. But when you get to yellow, it says, yeah, we might be moving down, but the momentum downward is getting weaker. Okay, so what I'll end up doing is that I really like to take a look at the Wilder or the ADX. Okay, when you take a look at the ADX and you take a look at some of the work that Weiler had done, I think it becomes a lot stronger. Now, this one I ended up going to, and you can end up seeing that I just cut this morning because here's yesterday's. Okay, and here's today's movement. And so what you can end up seeing, the red line being the short one here, is that it's definitely getting stronger, right? You can see momentum is forming on this. And so when I take a look at the different momentum factors, and I'm going to have to go into this because when I save this, I guess I didn't save the whole thing. There are a few things underneath it that I'll end up showing you. Oscillators. Okay, well, momentums tell you that, think about what the differences are, and this is an important thing. Momentum says, I'm going to be a trend follower. When the markets start to move, okay, in one direction, I'm going to jump on the bus, and I want to end up moving in the same direction that the market ends up moving. So I kind of group those together, okay? The strength of the move, the direction of the move. Oscillators are the exact opposite. It's almost like saying, when do I want to end up buying? When do I want to end up selling, right? I want to buy low and sell high. So, oh, by the way, one of the other things that you'll end up seeing here that I did mention on momentums, and I'm sorry to end up going back, but it's an important thing. I take a look at the moving averages on this particular page. I want to end up taking a look at moving averages, and the two that I'll look at is I'll look at simple moving averages and I'll look at exponential moving averages. Now, remember, exponential moving averages will end up holding a lot more weight. And because this is so small, I forgot which one is which. The 200-day exponential, I'm pretty sure is going to be the solid line. I'll show you in a minute. And then the dotted line will be the 200-day simple moving average, and I did that for all of them. Again, I'll show you on Thinkorswim. I'll open everything up, and you'll be able to end up seeing it. But I'll take a look at those different moves. And over here, I also have another particular indicator that I'll look at, and this one's called parabolic ZARs, crossovers. This one's used a lot more by institutional guys. But again, you can end up seeing, okay, many times the bars that end up working. Here, we'll give you a buy signal that we have a breakout, only to have it turn around, okay, and then come back. Remember, the bar that you see here, this green line doesn't go on until the completion of the bar. That's when it's valid. So on something like here, you didn't get a sell signal until the end of the day. Right now, granted, I'm looking at a daily chart. You can see that here, and yes, these things can be put down to 5-minute and 15-minute. And again, when I end up showing you, you'll be able to end up making those changes yourself. Tom, are there any questions? Okay, because guys, I want you to ask questions as we go through. Some of them I'm going to end up saying I'm going to end up waiting till I actually get to Thinkorswim. I probably need just another few minutes to get through the quick review.
The only question was, were you affected by the hurricane?
Oh, yes, I had to reset my clocks.
Okay, there we go.
Okay.
So, that's it for questions.
For those of you who don't know, I live in Palm Beach County. Luckily, by the time it came close to our shore, very close to where we ended up living. But because of the counterclockwise nature of a hurricane, and the hurricane being off to the east of us in the water, we had a lot less effects. We went to bed, the power was on. We woke up, the power was on. But boy, we were prepared. Anyway, oscillators. Okay, oscillators will end up being something that will show you where there's a lot of strength and it's starting to end up coming back, or vice versa, where there's a lot of weakness. What I'm looking at here, and there's a lot of them, right? I look at MACD, stochastics, RSI, Williams percent R, and CCIs. And what I'm basically looking for, I'm looking for a confluence of indicators. Are they all saying the same things? We'll go through this. I'll tell you that CCI and Williams percent R are the fastest. RSI is probably more middle of the road. The full stochastics and the MACDs are the slowest. And so you'll end up seeing, okay, the faster a indicator, and if you take a look, it's pretty easy to see here with Williams percent R, is a lot slower than the MACD, which means there's going to be a lot more noise in this indicator. And again, I'll show you how I end up using them in just a couple minutes. The other thing is that I reserve a page or a chart, okay, for doing nothing but drawing trend lines, support lines, Fibonacci's, and gaps. Okay, and I'll end up showing you what I've done here. This is the S&P, and I'll go through why, at least in my Kevlar service, we put something on, and I didn't put the full position on. I had a position on where I considered it where I was risking, let's say, one, if the market went up, I was going to lose 1 unit, and if it went down, I was going to make 3. Okay, I'll take that bet every single time. And what I did was I had my technical analysis that said if the market goes down, it can go down pretty hard. So you need to be aware of the downside. So I was like, this is great. Why do I need to end up putting on that extra one call? Let me wait. And I'll end up showing you, okay, this in detail when we end up going through it in a few minutes. And that was it on this. So I'll end up coming back to the slides, and let me end up showing you what we end up having here. So what I'm going to end up starting with is I'm going to end up starting with the one that I'm going to be able to show you because of where we are. And this is going to end up being for anybody who's a member. Pay attention here because this is the part where you're going to end up being able to end up starting. When we send this out or you download this, Tom's going to end up including all of these links. Okay. I was the one who saved them. So on my tools page, underneath shared items, these were the things that I've recently shared. So what I'm going to end up doing is that I'm going to end up copying, okay, the link over here, and you'll end up doing this at home, okay? And you now have, right, once you copy the link, and I couldn't figure this out for a long, long time. You ever do something and the answer's so easy that you feel stupid afterwards? It was like, I can't believe I didn't know how to do that for months, or I struggled for 6 hours before I called up TOS support. That's the way I felt here, right? So I'm going to come over to here, and the first thing we're going to do, and this is where I always start big picture S&P. All you do is you come up to Setup, okay, Open Shared Items, paste the URL. I'll pause now because everybody who's not a member, okay, who's looking at this is scrambling to end up getting the URL. Okay, you guys have it. You first have to preview, then open. Let me make this big. Whoops, I messed that up. Did I not make it? Sorry, I guess I don't use full screen like this. No, I don't want to close. Let me do that one more time. Well, here, but by the way, I'm just going to do this, okay? Let me do it again the way you have to do it. Copy, come to Setup, Open Shared Items, paste the URL, hit Enter, and hit Open. Okay, and here is the entire graph. Now, what I tend to end up doing is that I like to leave trend lines on or specific items where I thought were major support or resistance line and leave them. Now, some people saying, Jim, you're being a little bit extreme here. I mean, do you really need to end up keeping March 2000 high? Well, I don't know. I'm not going to delete it yet. If you take a look at some of my trend lines were from the 667 low that we had in March of 2009. Okay, let's go to a little bit more current. What I'll end up doing is that when I see particular necklines that are strong, okay, if you take a look, this will hit a high. I'll end up leaving it on here. I have one Fibonacci on this graph, and it's 2 years old. It was a Fibonacci that we ended up starting, okay, in October of 2014, and we ended up hitting our high in May of 2015. If I come over here and let's make this a little bit bigger, there's my trend line. Now, why did I end up keeping that? Well, look at what happened when we sold off in February, okay? We broke it a little bit intraday. We broke that huge support line that I ended up having, price trend line that I had from, 4 years ago, and that ended up being the support that we ended up moving up. Okay. When I take a look at this, the reason why I take a look at Fibonacci's, again, I'm looking at confluence, right? Multiple things that are telling me the same thing. Okay, here were the previous highs, okay, that we ended up having back on May 21st of 2015. I'm sorry, 14. So I'm looking at, a high that was 2 years ago. I think that not only highs are very important, but I also think that shoulders and shoulder length is really, really important. So I will usually draw a line from the left shoulder, right? You can see, right, head and shoulders patterns here multiple times. Look at this. We tried 1, 2, 3 times to end up breaking, okay, through the high, and we couldn't. Okay, so it was pretty major that we couldn't end up getting through that. And having the previous high and that right shoulder level, every time we ended up breaking the shoulder, okay, I start to worry, well, how far are we going to end up selling off? Okay, so again, shoulder lines, and I'll end up keeping shoulder lines. Sometimes are even more important if they are going to be used again. Like, look at this left shoulder here. Look at how well it reads support. Now, I'll end up having other lines drawn, but when they stop showing any type of relevance, I'll end up deleting things as they get older. If I come back here just a little bit, I want you to see this trend line. Okay, a lot of you will remember, okay, the beginning of the year, right? We had some pretty harsh sell-offs in January and then made even a newer low in February. So what I ended up doing is that I drew, and you can draw them any ways you want. I tend to end up drawing from peak to peak. Some people say, well, I like to end up doing it from body to body of the candles. You guys can end up doing what you end up feeling. I've just done peak to peaks for so long. I think it works better. Things are more clear for me, but it's whatever drawings work best for you. What I'm trying to do is share with you the way I end up taking a look at things. Let's take a look at just this year. Okay, because it's easier. So here's the trend line, right? So I draw this trend line from here to here. Okay, I draw it from the lows that we had on December 11th to the lows that we ended up having the second day of Brexit. That was the day I drew the line. Totally meaningless afterwards, right? Because it bounces up. Totally meaningless until we see where the market closed yesterday. Right? Look at this. When you want to talk about a confluence, I have a I have a crossing point here between my trend line and a previous high. Is it any wonder that this was a support level? Okay, I don't think so. I mean, when you have this type of stuff on your charts and you're looking at them, one of the biggest problems I used to end up having is, okay, the market's going down. How much further is it going to go down? Now what I end up doing is that I wait it. Okay, I wait. I'm going to end up making this smaller, but I'm going to end up coming back to these circles in a minute. Okay, so what I ended up taking a look at, here's the current market. Okay, with yesterday and today in it, right? Because we're looking live on a daily chart. So I have this pennant formed. I drew my first pennant from here to here, and the line went straight down. That became meaningless, so I deleted it. Then I drew my second pennant when this line happened. So when we run up, is it any wonder that we kind of got to the top of the pennant that I drew only for it to end up coming back? So one of the things, at least my Kevlar subscribers will know, is that they've heard me railing about this for at least a couple of weeks now, is that we're getting this compression of volatility, meaning that we're getting this pennant. We're getting higher lows and we're getting lower highs. So we have this pennant or this, sideways triangle forming where things are getting narrower and narrower and narrower. Now, what ended up happening is when you take a look at the 20-day moving average, and I'll take a look at this in a little bit, but we had, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, okay, that went through the 20-day moving average. That was something like Tom, do you remember what it was? It was like the 14th time in the last 28 years or something that we have crossed the 20-day moving average intraday for whatever it was, 11 or 12 days in a row.
Yeah, I'll look it up exactly. I can't remember the exact number, but give me a
Yeah,
minute.
but
I'll get
okay,
it.
yeah, but we ended up, and it was funny because I was railing about this that getting this compression and volatility. We need to be careful of which way it ends up going. And so as we were going through this, and after about my fourth day on the soapbox, Tom and I subscribed to a couple of different newsletters, and one of the newsletters came out, with this type of research. A couple of things that I'll point out. These arrows here are for you guys. So I have this upward trend line that I drew on this day, right, on September 15th, and it just sits there. So when it comes back and it says, "Ooh, look at this. It kind of looked like it was support here. It kind of looked like it was support here." Then we broke it. When we were down here, I'm like, okay, we've broken through the pennant. Time to end up putting on our butterfly. Okay, and so what I did was for my own trading, and you do whatever trade that you're doing, but I put on, I scale into, my strategy, and I had multiple butterflies. Sometimes I use regular butterflies, sometimes I use broken wing butterflies, but it was time to end up putting on a butterfly below the market, and obviously we've broken this, so at this point, we're definitely going to go down to, 2135, no question about it. I'm going to put on this butterfly, and the market's going to drop, 12 points, and we're all done. Okay, then we'll make money, and I'll lock everything in. Did that happen? No. Okay. So we went above it. Now here we came back up, okay, and we were right on the trend line. So I'm thinking, well, if we're on the trend line, we broke it. A lot of times we'll break it and we're going to go down. Next day we move up. Next day we move up. Okay. I never bought my by the way, in the strategy that I end up doing here is that it is a below the money butterfly, and I'm buying a call. No, it's not an M3. And so I just waited. I waited. Why? Because I had no reason. To end up being forced to buy my call. Why? I had on half of my position was fully on. The other half was missing one call in a $50,000 account. And so I looked at this, and if the market ran up, okay, volatility was going to come out a little bit. I was going to make some Vega dollars. We ran up, and I took a look at what my risk would be to the upside. I also took a look at how much money I would make to the downside. And through my own analysis, I viewed the fact that, my Kevlar position at the time was risking one unit, whatever that might have been, right? It would have been about a 2%, 3% loss, okay? Versus if we ended up going down, I was going to probably make 6 or 7%. Okay, and that's if I didn't end up using volatility. Using volatility, I was probably looking at a 2% loss versus a 6% gain. So in my mind, if it runs up and I have a 2% loss, I can end up managing my trade through the exit end of the trade that, I can hopefully, and I have been able to so far, but hopefully I'll be able to end up managing and squeezing out, a plus number, not a big number, but is any positive number, okay, is what I want to end up seeing if markets move against me. But if it moves down, I'm going to be able to do well. And so what ended up happening after this, we broke it, we came down, but we didn't get to a new low. You see this here? So I didn't buy my call. And then we came back up and we ran up, and I'm like, I'm a jerk. Okay. And by the way, I'm getting emails constantly from all of our guys because I guess a lot of folks have traded with the market direction. And I'll get into that in a minute. But meaning that, I started, so let me do it. Meaning that when we put on our position, okay, because they're sad face traders, meaning that their T plus zero line bends downward, right? They're a short gamma trader which means that the more the market moves, okay, the worse your position is going to be. Now, I know that you set them up differently, left and right, up, market moving up, market moving down, and all of that. But what I always try to end up doing is I try to keep my positions at least at the money. I know they're going to turn a negative gamma if we have a big enough move, but I at least try to end up keeping my trades positive gamma. And so we were positive gamma. My deltas, okay, weren't going to hurt me if we ran up. My position was well hedged. So, I sat there and I had patience. I said, because either it's going to break through the top of the pennant and I'm going to give up and I'm going to, be down my, 2%, maybe 3%, and then I'll end up managing it from there. Or the market's going to end up breaking down from it and I'm going to end up, having my 6% in the bank, right? You give me a market, that has a 50-50 chance, and right, every market in the short term has a 50-50 chance of going up or down, and you give me 2-1 or 3-1 odds, I'll take that bet every single day of the week. Okay, so I held the bet. Anyway, so when the market ended up coming down, it was funny because we actually were doing our monthly review. Okay, right, because I do a monthly review in a Kevlar trade service, and I actually ended up starting at 10 o'clock. By 11 o'clock, 11:15, we were kind of done, and it was time for me to end up putting on the position. So for at least those of you who are Kevlar subscribers, you'll actually see I kind of opened up the trading room and I showed you, hey, this is exactly what I end up doing. I had done a lot of my analysis beforehand, but we ended up buying our call. Is the market down from where we ended up buying our call? Without question. However, when I bought the call, what I did was I flattened out my delta. Now think about this. How many of you bought delta yesterday at lunchtime or later? We did. Okay. Do you remember for those of you that saw me do my Kevlar things, I take a look at, I said, you have to end up taking a look at what's your edge. Well, I think, I can do technical analysis reasonably well. But one of I consider my edges, I gave you guys the story about the $2 versus the $5 umbrellas. For those of you who didn't hear it, the quick version was, when I was taking economics in school, I walked out of class one day, and there was a street vendor, in downtown Brooklyn where I went to school, and he sold two things, sunglasses and umbrellas. And he had two signs, a $5 sign and a $2 sign. And when I walked into class, it was sunny out, and the sunglasses were $5, and the umbrellas were $2. When I walked out, it had just started to rain, and I looked over at the street vendors. It started to rain, and what he did was he switched the signs. Now the umbrellas, when it started to rain, the umbrellas were $5 and the sunglasses were $2. You now understand the law of supply and demand, elasticity, and basically everything you need to know in microeconomics, because that was just a perfect example. Well, what I try to end up doing is I try to buy $2 puts or $2 umbrellas. I try to buy $2 calls or $2 umbrellas. So I didn't want to buy my call when we were bouncing up. I wanted to end up buying it when, we had, some decent momentum going down. And so I paid several dollars less by waiting a few days to be able to do this. Now, could it continue to go down? Yes. Did I flatten out my deltas? Did I end up making, my position? No. My deltas morph. Everybody's deltas morphs, meaning that where your, not just your delta, your Greeks morph, where your Greeks are today are not where they're going to be tomorrow. Okay, if the market moves up, if the market moves down, if volatility moves up, if volatility moves down, if skew changes there, right, time's obviously going to end up affecting it. Things are going to end up, changing. Okay, and so when I take a look at this, think about what I did, and this is the way I use my technical analysis. I didn't buy my call. So by not purchasing a call, if I have a call, I'm going to have to end up paying theta on that. So by not buying the call, I was actually keeping some of the theta that I might have had to end up paying for it. So I got to end up keeping 1, 2, 3, 4, 5 days of theta, and I bought it at a lower price. Where are we now, by the way? Kevlar's up 7% on the month. Okay. And what we'll probably start to end up doing is scaling out by next week. Hopefully, I'd like to end up starting to end up closing. This is the way I end up using my technical analysis. I'll end up putting on trend levels. Remember, I told you I'm real fond of left shoulders and heads. So I'll end up putting them there. What I find many times is that when you end up when you end up coming down below the shoulder level again, if you're going to come up, you got to get past the left shoulder before you get to the head. So I always want to end up having that. I told you I'd end up going back at one point. I strongly believe that gaps fill. Okay, if you go back in the history of the S&P, what you'll find is probably one every 3 years, 4 years, 5 years doesn't fill. Okay, we have 2 gaps this year. Okay, in the last 8 months that haven't filled. We have a gap over here on the S&P, okay, that we came off of the bottom. And by the way, that's usually when gaps happen. We ended up having a gap here coming off of the bottom in February that was open. We ended up having a gap here a couple of days after Brexit that never filled. Okay. One of the things that we ended up talking about, and you guys, meaning the guys on Kevlar service, will end up seeing this. I had this circle drawn for a long time, okay, because there was a gap right here. You can see this sell-off that we ended up having on that fateful Friday day when we ended up having, the markets end up tanking somewhat, only to end up having the markets fill the gap, okay, over here. So I deleted it. We also had a gap over here that filled here. Right? So as gaps fill, I'll take them away. Oops, I never took away the arrow that showed where it filled. And so I want to know where those gaps are because many times when I've seen markets in free fall, okay, or running straight up, gaps tend to end up being a really big, in this case, support level, or if they're above us, a really big resistance level, okay? And so this gap over here that we ended up having, okay, that was formed on 9/9, that huge run up, okay, it ran out of room because it filled the gap. What that meant to me is that when I drew this trend line, okay, this trend line was something that was really important, I thought, because of it was kind of an exhaustion run up. And then I thought it would end up holding. And if you take a look at it, it held once, it held twice, okay, when it was threatened. So, this compression that you end up seeing, I think that looking at this, I will tell you when I look and I do my technical analysis, 80 to 90% of my time is spent looking at this stuff and not so much the indicators. Okay, so that's why I've taken so much time here. What I'd like to end up doing, or what I had planned on doing, was going through some of the indicators. Let me go through the indicators. And Tom, if you would end up either asking the folks or do a quick survey, if you want, we'll end up drawing some trend lines if we have a few minutes at the end.
There's a question about the EMA and SMA, about the 20, 50, 200. Which one is SMA? Which one is EMA?
Okay, let me go through that. Let me come over here, and the way I end up having it is let me go through the momentum. Right, I can do that from here. I can reload. Okay, but by the way, let me reload here. Let me start it. Okay, I'm going to end up doing this for you guys, but what I want you to see is, you know what? I'll show you. Let me do this, and then I'll show you how I save it, since I've already closed the other one. Okay. So again, all you'll have to do is get, okay, as a member, just get the downloaded files that Tom will end up sending you. You end up coming over here. You end up going to load. I'm sorry, to it's not on this one. It's on the main chart. You go to Setup. And you end up doing open, okay, shared items, and you can end up pasting it there. Okay.
And Jim, I built a little web page. It's got all the links on it, and I'm pasting it in the chat for everybody who's on the call right now. So you have it whether or not you're a gold member. And if you can download files in the library, you'll be able to get this later on. So there it is.
Okay, great. So let me end up showing you, once you end up saving things, what I do is I end up saving, okay, grids. Okay, I'm on charts, right? TOS charts. And what I'll end up doing is that you wanted to know about momentum. So it was momentum 2. Okay, so here's all you have to end up taking a look at. Everything will be over here. Is if you take a look, the easiest way to do this is to go to Studies, Edit Studies, and there's everything. Okay, so if you want to end up seeing, you saying, you know, Jim, I watched this thing and I don't like 50-day moving averages. Okay, I think that for my exponential moving average, I shouldn't use a 50, I should use an 89. So all you have to do is double click on it. Okay, you can end up seeing here, by the way, that the exponentials are the solid lines. I'll open up the simple moving average in a minute. You can come in here and you can say, well, I like using 89-day moving averages. You can end up changing it any way you want. Okay, if I come over to here and I end up taking a look at the simple moving averages, and they're further down here, there's the 50. Okay, you can see here that the style is the dotted line, and you can see here's the color. Right now, if you're not sure about that, it depends on how much room you have on the top. Okay, I have too much crap on the top, but if you take a look over here, it'll show you the exponential moving average. Okay, for 50 is yellow. Now, you don't know which one is which, but you can end up seeing all of that. And so let me open up Studies again just for everybody who may not be able to download it. Okay, and so what you can end up seeing, the way I set this one up, okay, I used exponential moving averages. Okay, those are all solid lines. What I tend to end up doing, okay, and by the way, you should use your own, whatever you're comfortable with. I'll tell you that my 20 days or my shorter ones, usually 20 days, 20 periods are always going to be this aqua color. I use yellow for the in-between one, and then I use red for the long one. So I know just from what I've done is that I know that, number one, that these are going to be, well, also look at this for a second. You know, okay, because we've had this trend, okay, that the things that end up moving up higher and quicker are going to be the 20 days. These are going to end up being the 50 days. The slowest ones are going to be the 200 days. You know when you have a move up, okay, that the exponential, because of the higher weighting with the shorter term, you know that a 200-day is going to end up being closer to the market in a run up than is going to end up being the simple moving average. So I can end up seeing all of that. Now, that's important for the lines. In this one, I also like to end up seeing, if you remember, I talked to you a little bit about hyperbolic ZARs. These dotted lines right here, and if I show you this, I have the hyperbolic ZAR, okay, right here. Again, and I'm just using standard ones. If I want to end up taking a look at it, I can double click. It shows me that it's yellow. It shows me that it's a dotted line. Okay, and I can see where it is. And you get a buy signal once you pierce that line. Now, on a daily basis, we finally pierced it on this day, only to end up having it come back and be a complete disaster of a trade. Okay, so I sometimes actually fade indicators. I do, okay, because you know what? I know that one doesn't work very well. At least I'll take a look at it. Now, I'm not ever trying to time something perfectly. I'm just trying to end up buying a $2 umbrella instead of paying $5 for it. I didn't want to pay a lot of money for that call. Okay, so I just put on the trade, and what I always try to end up doing is I try to trade in the opposite direction of the market. I know, one of the things that I should probably end up doing, for my Kevlar class is that I'm going to have to end up teaching you guys how to unteach you some of the stuff that you've learned. Okay, if you were, a trend following, adjust the trade when it gets out of the butterfly or out of the tent, Sheridan type of guy. Okay, doesn't work. Doesn't work. Okay, maybe it worked 25 years ago, but it doesn't work now. Anyway, so I take a look at that. Here's my hyperbolic ZAR, indicators for the bearish crossover. I also have one for the bullish crossover, and let me get to the rest of these things. And then the simple moving averages. That's the top graph. Okay, second graph. Okay, going down. Each one of these things I've put in its own separate subgraph, and you can see that I've drawn them down to lower files. Here's the ADXR Wilder. So if you want to end up seeing, and again, I'm not doing anything, okay, but using the simple ones that everybody else uses. Why? Because I want to see what other people end up doing. You end up taking a look. There are going to be two lines on it. There's going to be an ADX and an ADXR. And you can see here, again, what I'm trying to end up doing is that I want to end up making, my faster moving indicator in this one, red. I like to end up doing that sometimes. If you say, no, Jim, I like to use other colors, you come in here, you change your colors, you change your style of your line. You say, well, I went to this class and, 14-day while or 80 hours don't work. Okay, I have to use 5 days. Well, we'll change it. Okay, you can change it to anything that you want. Okay, so those are what I end up doing. I wanted to end up just showing you just a little bit more on this one. Again, edit studies. Let me move this up here. And here's the DMI. Okay, you can end up seeing you have 3 indicators. You have the DI plus, the DI minus. You can see, so this is the bullish one, this is the bearish one. So you can end up keeping the trade any way you want. I don't like to make my bullish stuff green, but I keep it close to green, so that's why I use that aqua. I don't like to make my bearish ones, okay, red. Okay, I'll make them white. Okay, or I'll make them. Actually, this is an older one. You know what I'm going to do right now? I'm going to end up showing you how to end up changing colors. Oh, I want to do solid red here. Red is in here. I go into more. There's not a perfect red here, so what I'm going to have to do is I'm going to have to go into the RB, right? The RGB. I'm going to end up picking red at the very corner here. I'm going to say OK. Oh, I forgot to end up applying it. Sorry about that. Did everything but the last step. RBG, red. Okay. I come OK here. Now it's red. That's good. I like doing one at a time. You can also do apply. And then I have to do the ADX. And the ADX should go to white. And white I can just choose here. I'll hit OK. Hit apply. And that's the way it should be. Okay. And so there's my indicator. And Tom, I'll end up giving you the new link. I'll save a new one for everybody. Anyway, you guys who are on it, you end up seeing it. Next thing I'll end up taking a look at, I really like the DMI oscillator. It was one of the things that I ended up taking a look at. And now, so here's a great example, okay, is that we're moving sideways for freaking weeks. Okay, we recover from the oscillator, things get positive, and now for the next 2.5 weeks, the oscillators can't get positive. They can't get positive. Okay, doesn't mean that they can't go lower. But I'm like, if we're moving sideways, why are we there? What I found is the DMI stochastic extremes. Take a look at this, and this is one I do give a lot of weight to. Right, this one I look at as fool's gold. Right. This is the 80X crossovers, but I take a look at the DMI stochastic extremes, and here's one of the things that when I go to the oscillator page, I'll show you. One of the investment managers that still calls me up, okay, to end up going over technicals. He's like, Jim, I have a couple of stocks. Will you review them with me? And I take them through these. The expression that I'll end up using when we take a look at any of the oscillators is that you can live on the ceiling or in the basement for a long time. Okay, meaning that just because you run up doesn't mean that the oscillators have to come down. They can end up being up there for a long time. The little blip may end up taking them down only to have them go back up on the ceiling. But many times, okay, they can end up helping you. Again, do I end up using all of this stuff? I really think that the price levels, okay, should be your first place to end up looking, and then the oscillators, the momentums, however you end up trading, should be your supporting cast for those main charts. Okay. Other ones that I just wanted to end up showing you that we ended up going through was the oscillators. So one of the things, I show you this big chart here, but again, one of the things that I like about Thinkorswim, and let's go from breaks it in over here. By the way, you see how my color-coded lines are? Okay, and so I try to almost make them like a rainbow. It works for me again. I put in an orange here for the 100-day. So again, what do we have? And you can actually see it here. This happens to be the exponential. On some charts, and I know which ones I have. I know on my oscillators, I use exponential. I know on other ones, I'll use simple. And so this way, and then on one of them, I'll use both of them. So at least I'm looking at them, and I'm looking at where those support lines are. When you end up having your 50, right? Okay, you have your 50 and your 20-day. Look at how freaking close these things have been for weeks. Okay. Again, that's another sign. Okay. There's nothing. Oh, look at this. Okay. And on the other charts, okay, we also happen to have the 100-day that ended up acting as perfect support. Okay. Yesterday, and it's looking like it's being supported again today. Okay. So these are the types of things that you take a look. Look at the 100-day over here. Okay. It was a multiple support. Now, some people, I don't get crazy with this stuff. Again, I remember seeing somebody said, I don't like the 50, I don't like the 100. 89 days work much better because when I did back testing, when you did back testing, you curve it. I got it. It worked when you back tested. I'm looking at the rounded, century marks, so I'm going to look at the 20s, the 50s, the 100s, 200s. Why? Because I know that those are the big ones that all the big guys are looking at. So do you think it is any coincidence that after we had that big sell-off on 9/9, it ended up being support, and for the next, 3 days when it was trying to break through it, the 100-day kept holding? Okay. If we did end up going, if you thought the 100-day held, the 200-day would definitely be another level that I would look at again as support. So I'm not looking. Remember, we're not trying to end up making quick trades, but we're trying to end up taking a look at where do I need to end up protecting to. Right? How flat do I need to make my T plus 0 line? And I always err on the side of conservatism, meaning that I want my T plus 0 line to be flatter, okay, as possible as it can. But I'm not going to do it in a total vacuum. I'm going to look at this stuff and say, I need to end up being a little bit more supportive there, a little bit more supportive there. MAC keys, when they end up running, okay, is the first oscillator. I think probably the most commonly used. When the markets move up, again, just like this is where the Pearson's TTM squeeze ended up coming from. The lines will be brighter green, darker green when the momentum is starting to come down. You can end up taking a look at, I'll use a 2-line, okay, then I'll end up printing out the differential. Again, standard stuff. I don't end up changing these things. I want to end up using the way they were meant to end up being used when they first came out, or the way most people end up using them. Look at the confusion, okay, over the last couple of weeks. You can see that the fast line here is purple. The slow line is yellow. You can see in the full stochastics that, again, we've been doing this slow trend down while the markets have been moving sideways to up. That's not a good indicator if you're a bull. Okay. The RSI, again, it moves a little bit faster. You'll see a lot more noise in it. But again, if I go from, once we ended up recovering, it's moving sideways. Okay, of course it moved down yesterday. Okay, Williams percent R move a little bit faster, and here's what I end up meaning about living on the ceiling in terms of, yes, you could end up staying up here, but a lot of times you'll end up coming up. Look at during this bull run here. Look at how long, okay, everything stayed up in the attic, right, up on the ceiling. Okay, we stayed up here for a long time, which means that when we start to end up breaking down, it doesn't mean so much that we're breaking down. Remember, they're oscillators. It means that it could be weakening. And it did. It weakened a little bit only to get strong and then go back up on the ceiling again. Right? There's nothing perfect about this stuff. Okay, there's not a magic formula. It's not going to work all the time. One of the things that I like most about CCI, okay, and if you ask me, Jim, if I looked at just one oscillator, which one would I look at? I'd look at CCI. I'd also tell you to put MACD underneath it because CCI reacts quicker. Now, if you take a look at the CCI indicator, it reacts quicker, but there's not as much noise in it as the Williams percent R. When you get a sustained run, okay, what will end up happening is things like Williams percent R, okay, these guys will get up, okay, if you take a look at here, which ones, okay, got above there. Oh, by the way, these are also trend lines that I drew, okay, so if you end up going and taking a look at your Williams percent R or any of these things, you won't find these lines in here. They're lines that I end up doing. What I'll tend to do is I'll end up putting yellow or red up on the top. Okay, I'll put green, because it's right, that means I need to sell. The green are buying opportunities because you're at the bottom. Okay. By the way, just because you're the bottom and it's a buying opportunity doesn't mean the market's going to end up going down. Remember, I don't know how many times I've quoted, Keynes, who said, never forget that the markets can remain irrational longer than you can remain solvent. Anyway, so you end up taking a look a lot of times, okay, that buying opportunity will snap right back up, and it was a great buying opportunity if you ended up using these as a trader. I don't. Okay, I don't try to end up, picking bottoms. I'll end up trying to do when I have positions to end up buying when the market's down. But you know what? If the market ended up going down, another 2 days like we just had, guess what I'd have to be doing? I'd be rolling down too. Does it work well? Yeah, it does. It gives me a lot more time. I can be more patient. Did I roll down one of my trades the second day of Brexit? Did I miss picking a bottom? I had to roll one of my butterflies or a portion of it down. Did I roll it down about a half an hour, away from picking the absolute bottom before we bounced up? Yeah, I did that too. Okay, so you're going to end up making mistakes. And then what did I have to end up doing? I battled for the next next 3.5 weeks, till I finally got my position back to, break even and up 1%. But it was an absolute pain. But at least this gives me an idea of when we're running up. Okay, where are we? When's it going to end up slowing up? How much patience can I have? I'm always looking for not trading. I don't want to have to end up trading. I want to put my positions on, and I want them to end up reading. And I'm trying to use technical analysis to be able to do that. Tom, if you'd end up asking folks, or if you end up sending to Tom, if you want me to end up drawing lines on a sheet, I will end up doing so. And then I think that will end up being it for today.
Yeah, we're a little over an hour, so
yeah.
I don't think there's any more questions, really.
Does anybody want me to draw for trend lines on a particular underline? You guys care? Type it in. Apple, Rut. Tom, what one do you want to see?
Well, I trade SPX primarily.
As do I, and so that's where I spend all of my time. What I'll do is that I'll end up showing you guys real quick Apple. I don't know if I have drawn anything over here. Do I have an Apple here? Oh, yeah, I do. Okay, so let me show you Apple real quick. I'll tend to end up saving these things. Okay, again, always start with the big picture. These trend lines, by the way, I want you to take a look at something. Okay, peak to peak. Okay, I drew it from 2007 peak that Apple had before the big sell-off. It drew to this trend line, and look at what ended up happening. This and this both ended up being great peaks. Don't get rid of your stuff. I drew a Fibonacci. Again, I'm trying to look at the last major Fibonacci over the last couple of years. If there's been a big piece for it, I drew the Fibonacci on it. I then ended up taking a look at a bottom trend line. Once we ended up breaking the trend line, it really ended up hurting. Let me come in a little bit closer. Some of the things that concerned me about Apple was that we ended up not being able to end up breaking. If you take a look at this, right, they had their own little pattern. Let me come over here, right, their own little pennant. And once it broke through, boom, it really snapped up. Okay, really troubles me. Okay, that Apple has these gaps, below hand at 106, and this is the first time I've ever seen a double gap unfilled, at 101. This is a volume bar, so don't look at that. Okay, here is the top of the day on the 27th and the 28th. So there's this huge gap. It was an earnings gap down. And then when we had the next earnings, we gapped through it to the upside. So I kind of take a look at this, and it's I don't know when. I think Apple caught a couple of breaks, with Nokia and Samsung making devices that explode or go on fire. Take your choice. And so they've gotten some help here, but I would be concerned about the downside. On the upside, if we end up pulling, if I'm bullish, I definitely see this trend line, that's acted. I ended up originally taking a look at this, and I was like, oh my God, look, going back. And so this one I did not draw from here. This one I ended up drawing in after it hit it about the third time, as I was looking back, and I was like, oh my God, I can end up having it. It acted as a support here. It acted as support that once it broke, it went through, and then it's acting as resistance. And so if we end up pulling back, I think that, either the 115 level, or the trend line, depending on when we end up getting to it, would end up being good entry points if I was long. If I was short, once it ended up breaking those things, if I want it to be long, right? If I want it to be short, I would end up waiting it to end up breaking. This line, this trend line, and then I'd end up going through the same thing that I went through with the SPX. So I hope that this was useful. I've tried to end up giving you the way I do technical analysis for professional money managers, and like I said, I've done it I do it for a few of them. I try to end up giving you the same tools that I end up using on Thinkorswim, the drawing tools and the different oscillators. Remember your drawings. Once you learn to be a good technical analyst, you'll end up learning how to end up drawing your lines. Tom, what I'll end up doing is that on the Monday Market Muse, I will end up sharing, the weekly SPX, chart, because the lines are only good for so long, right? You have to constantly look at them. So on a weekly basis, I'll end up sharing with you guys, what that is, and that'll end up being in the Monday Market Muse for anybody who ends up watching it.
Sounds great, Jim. Really appreciate the effort and sharing all these interesting technical analysis tools.
Well, thank you. I hope it was useful, folks. Take them, use them the way you end up wanting. I've given you mine, as a base from what I've learned over the years, and I wish you the best of luck.
All right. Thanks, everyone.